By the middle of the year, most businesses have enough financial data to see what's actually happening. The question is whether they are using it. In a lot of cases, the first 6 months just pass by. Revenue comes in, expenses go out, and the business keeps moving forward. The numbers exist, but they are not really being used to make adjustments. And that's usually where things start to drift, because by the time you get to the year end, the outcome is already set. There's very little you can change at that point. Mid-year is different. It's one of the few points where the data is meaningful but still actionable. You can still adjust how you're operating, you can still make decisions and affect how the rest of the year plays out. But for that to happen, the number needs to be clear, and that's where most businesses ran into issues. On paper, everything looks fine. Reports are available, the bookkeeping is being maintained, but when you try to answer simple questions, things get blurry. Revenue is up, what's driving it? Expenses increase, but where and why? Cash feels tighter than expected even though the business looks profitable. The disconnect is what makes mid-year difficult to interpret, and most of the time it comes back to the structure. When bookkeeping isn't consistent, comparing one month to the next becomes harder. Small differences in coding and categorization start changing how the numbers read. Over time, patterns disappear, and without pattern, decisions get harder. Cash flow is usually where this shows up first, because profit and cash don't move the same way. Revenue can be recorded before the cash arrives. Expenses can be paid before they hit the P&L. Tax obligations can build quietly in the background. If your bookkeeping doesn't clearly show these timing differences, uncertainty starts to build too. Inventory can play a role in the mid-year bookkeeping review, especially for e-commerce businesses. As sales increase, inventory needs to be replenished. That requires cash upfront, often before the previous cycle has been fully converted back into cash. So even though the business is growing, it can still feel there's a pressure on cash. Again, the issue isn't growth, it's visibility. If you can't clearly see how the cash is moving through the business, it becomes harder to manage it.